In this presentation, I will be discussing Fasb Accounting Standards Update 2019-2. Due to some major changes in the production and distribution over the past few decades, stakeholders question the relevancy of the Fasb codification pertaining to the film industry. Specifically, Fasb ASC 926-20, Fasb ASC 920-230, and Fasb ASC 920-350. The new requirements in this update are requiring an entity to test a film or license for impairment, new disclosures about content produced or licensed, addressing cash flows classification for license agreements, changes to capitalization requirements. The date of adoption was December 15th, 2019 for public entities with a fiscal year beginning after that date, and then December 20th, 2020 for all other entities. However, early adoption is permitted for public business entities for periods which financial statements haven't yet been issued, or for all other entities that statements are not yet available. All adoption of these updates should be applied prospectively. Some changes to the specific codification language are defining a film group and implementing the use of the term in the codification. The unit of account used for impairment, testing for a film or license agreement for program materials when the film or license agreement is expected to be predominantly monetized, with other films or license agreements instead of being predominantly monetized on its own. A film group presents the lowest level for which identifiable cash flows are largely independent of the cash flows of other films or license agreements. They also changed the use of cable channel to platform, as most people nowadays do not use a cable channel, instead have some sort of streaming service. The Fasb ASC 926-20-35-1 films or series predominantly monetized on its own or with other films, license agreements, the entity must reasonably estimate the value attributable to the films or series exploitation with its individual film forecast computation. For purposes of applying individual film forecast computation method to episodic series, multiple seasons are considered to be one product. 926-20-35-3B, an entity shall determine if the film or series is part of a film group when capitalizing costs by assessing whether it is expected to be predominantly monetized on its own or with other films or licenses. 926-20-35-3C, if a significant change occurs to the monetization strategy of a film compared to the strategy determined when costs began, an entity shall reassess the predominant strategy for the film. The reassessment must include an assessment of the entire life of the film. These significant changes could potentially include any unplanned changes in distribution. 926-20-35-19. An impairment loss attributed to a film shall reduce only the carrying amounts of a film or license included in that film group. The loss is allocated to the film group on a pro rata basis using relative carrying amounts, unless the entity can estimate the fair value without undue cost and effort, but they cannot reduce the carrying amount below the fair value. 926-20-50-4A. An entity shall disclose the following in the financial statements or notes: a separate aggregate amortization expense for each film or series predominantly monetized on their own or with other films or licenses for each period. The caption in the income statements where the amortization is recorded. For the most recent annual period, a financial statement is present and for the most recent annual period, a financial statement is present, an entity shall disclose the following in the notes of the financial statement, separately for films monetized on their own or with other films or licenses. For films completed but not yet released, the portion of costs that an entity expects to amortize during the upcoming cycle, equal to about 12 months, For films released, the portion of the costs recognized at the date of the most recent financial statements, the entity expects to amortize within the next 3 operating cycles, equal to about 36 months. If the entity believes that these costs will be incurred outside of the upcoming cycle, they must disclose that amount of months. 920-230-45-1. A broadcaster licensee shall report cash flows for the costs incurred to obtain rights acquired under a license agreement for program material as operating activities in the statement of cash flows. The capitalized costs of the license shall be included in the reconciliation of net income to net cash flows from operating activities. 920-350-50-1. An entity shall disclose the methods of accounting for rights required under a license agreements, including but not limited to the following: methods used in computing amortization, a description of the units of account used for impairment testing, and methods for determining fair value. Reasons for the update. This update allows for the full capitalization of film costs and revenues. Distinction between films and episodic series were established to address risks in producing episodic series that have a higher risk of failure. Significant changes in production and distribution models. Clarifying financial reporting statements. Amending amortization requirements. Adding revenue that is indirectly incurred, such as subscription fees, to the individual film forecast computation, and requiring the test of impairment when significant events or changes occur. Effects of the ASU. I found these effects based from a conversation in a podcast. Many companies can now capitalize on more of the assets on their balance sheet. Some cons, though, were that they can only capitalize prospectively from the date of change, and then potential for increased capitalization costs based on whether the content is a film or film group, along with requiring capitalization of each movie or show individually. These are my references, and that concludes my presentation on FASB ASU 2019-2. Any questions?